We are going to talk about gold, duh. We've been looking at a bit of a stealth rally for gold, and you haven't heard all that much about it. We are right near all-time highs, and so you would think that there's not much upside left usually in times like these, but that may be the wrong assumption.
Yeah, I do believe it is. And if you give me a second, I can go through the drivers that are normally driving the gold market. So number one, gold has been tracking our debt higher over the last 20 years. In 1995, we had $5 trillion in debt. It took us 200 years to get that high in debt. And in the last 10 years, 2014 to 2024, it's doubled again to 35 trillion. So you've got to ask yourself, are we going to be at 68 trillion in debt in another 10 years? So number one, we're following the debt higher in the bigger picture. In the shorter picture, we're in an inflationary environment. When inflation's good for precious metals, and that it's the debasement of the purchasing power of the currency that helps drive people into precious metals. So that's creating some demand because gold tends to hold its purchasing power over time. We've got two geopolitical conflicts. The war in the Ukraine helped to boost gold. And now we've got the Israel and Iranian conflict through surrogates, Hezbollah and Hamas. So the one thing that's missing from the equation right now is an interest rate reduction. We are seeing yields on the 10-year treasuries and the other treasuries coming down, which is the market gaming that the Fed will cut rates. And it's increasingly likely that the Fed will cut rates in September. And I looked at the last two times we went into a Fed rate reduction cycle in 2007. It was a different market. The Fed started at 5.25%. They got down to about 2.5%, and gold jumped 50% in price from 660 to 990. And that's before the great financial crisis erupted and gold eventually went to 1900. In this cycle, it's more reminiscent of what happened in 2019 when the federal funds rate was at 2.5%. It's as high as it got, and 10-year treasury yields got to 3.5%. Well, then treasury yields were falling before the Fed cut rates. Gold was 1330. It couldn't get over a 1375 high for 6 years. But then when the Fed did cut rates, gold jumped $200 to 1550 in a couple of months. And I think we're in a similar window right now where the market's waiting for that Fed to actually take a move. And when they do, that could give gold 10, 15% tailwind like it did in 2019, which would put gold into the 2,600 to 2,700 range from 2,400, 2,450, which is where we're at today.